covering the community, events, and people of Georgia, Carolina. This is the Means Report. Here is Brad Means.
Hello, everybody, and welcome to the Means Report. So glad to have you with us on this Sunday, and so grateful to you for taking part of your day to watch us. We promise to make it worth your while, something for the grown-ups and something for the kids, really, if you think about it today. We're going to cover a couple of important topics. Always love your feedback when we have our financial updates. I get a lot of thank yous out there where I really just don't do anything. I listen to Will Caywood talk, and we follow Will and Jeff Fehrman's advice, and so we're grateful to have the financial advice of Will Caywood in our first segment, he of the Fehrman Investment Group. And then I mentioned kids. It's time for back to school, and you cannot take eye exams off your list. In fact, they should be at the top of it, especially when you hear about the number of undetected eye problems that exist out there with our young people. So moms and dads and caregivers, please stay tuned for our second segment and find out all you need to know about the health of the young human eye. And big hearts, we always promise to leave you on an upbeat note. This week is no different. Two stories to leave you with today about people who really undertook tremendous acts of kindness. I think you'll like those. You're also going to like Will Caywood's advice. He is here from the Fehrman Investment Group. And Will, as always, my best to Jeff Fehrman at the office, and my thanks to you for being here.
Happy to be here. Thanks for having me, Brett.
I want to kind of we're past the midway point of 2015, but can you please take a look at the stock markets and the bond markets so far this year and just give us your assessment of how they're doing?
Sure. So the Dow, which a lot of people follow, you see it on the bottom right of your screen just about every day, whatever channel you turn it on.
Oh, yeah.
It was up a whopping 0.03% this year, so not a lot of movement there. The S&P was up about 1.25% for the year. NASDAQ was up 5.9%, and international was up about 5.5%. If you look at the bond market, it was down about 0.1% negative for the first half of the year. So really didn't have a lot of movement. We had actually a 9-quarter winning streak. So you go back to the beginning of 2013, go 9 straight quarters, and it was snapped in the second quarter of 2015. So a couple of the reasons for that, I mean, again, the first quarter was pretty good. Second quarter was down a little bit. But really, Greece, that was the biggest thing that was in the headlines seemingly every day, and also the strength of the U.S. dollar.
Yeah, I don't really understand Greece, and I think I speak for a lot of people. Why so much attention focused on that tiny country, and why was its effect on the world economy so big?
That's a great question. I mean, that's literally for a few weeks straight. We got that question 5 or 6 times a day, and it's not all Greek to me. I understand it a little bit more than most, but it's still...
You didn't.
It's still a little bit tricky. So it's gotten a lot of publicity, obviously, in the news, both locally and around the world. It's tragic, really, when you see the people standing in line to get money out of their accounts. I mean, you just think, what if that was here? How upset and how frightening it would be. So it's really difficult from a human standpoint. But when you look at it, kind of take a bigger picture from an economic standpoint globally, the size of the Greek economy is about the same as Connecticut. It's actually smaller than the state of Connecticut's GDP. So it's not that big of a player on the international economic scene. So from that standpoint, it doesn't really hurt us or affect the money around the world. Well, how it does affect us is it's in with a lot of bigger countries in the European Union. So you have Germany, you have France, you have the UK, and Greece, and other countries as well, but they're all kind of mingled together. And so what happens is a lot of the northern European countries are, in essence, loaning money to Greece, and then Greece is failing to repay them due to their entitlement programs and other things. And so what's happening is if Greece doesn't repay the EU, that means the EU has less wealth and therefore can't buy as many goods and services from the U.S. So it's kind of a domino effect. It trickles down to us eventually. So it is important, but it's probably not as big as some places make it out to be.
Yeah, you don't hit the panic button with Greece in and of itself, but you start to think about that EU and you really can get fearful fast.
That's exactly right.
Last time you talked a lot about volatility. In fact, in your past few visits, you've mentioned the word volatility, and I wanted to take just a moment today and get you to explain what volatility is and what its effect is on the stock market.
Yeah, so if you remember kind of late last September, October, volatility really cranked up. So we had a lot of ups and downs, and October was a very difficult month as far as volatility went. And basically what all it is the ups and downs of the market. So you have, some days are up, some days are down. And the more roller coaster like the market is, the more volatility you have. The flatter flatter the market is, the less volatility there is. And so what's best for clients' peace of mind, what's best for your investments is kind of a slow and steady rise in that. So kind of through the first half of the year, I had a couple stats. There was 28 days in the first 6 months of the year where the market was up more than 100 points. There was 27 days where the market was down more than 100 points. And so that just goes to show there was a lot of movement up and down, but we really didn't go anywhere. There was just a lot of back and forth. One neat stat too is the S&P hasn't been up more than 4% on the year or down more than 4%. So it's a very tight trading range to this point in the year.
What causes the volatility? You know, you can't really, you want to high five everybody the day the market closes on a high note, but based on what you just said, calm down because it'll all go away the next day.
Yeah, I mean, if you watch the nightly news, there's always a good reason. I mean, there's usually a good cause for why it went up or down, but a lot of it is uncertainty. It doesn't matter if it's politics or if it's U.S. economy issues, if a company doesn't report earnings well, it could be something on the global standpoint, but uncertainty is the biggest thing that causes volatility. The more uncertainty, the more volatility, the less uncertainty, the more volatility.
All right, you looked at the first half of 2015. Take a look going forward, break out the crystal ball. What are your thoughts on what we should expect for the rest of this year?
Yeah, so history suggests that it's going to be a pretty strong second half of the year. So again, going back to the tight trading range that we've had, in the last 50 years, we've had 6 years where the market hasn't been up more than 6% or down more than 6%. In the second half of those years, it's been a positive 6.1% on average. So if history repeats itself, it's going to be a positive look at the second half. Our chief investment strategist is optimistic as well. He believes that we'll have about 4 to 5% earnings growth for companies, and then we'll have about 2.5% share repurchases from those companies, and then you'll have a dividend yield on the S&P of about 2%. So we're looking for an 8 to 10% increase between now and the end of the year.
What sectors of the economy do you love or at least like at this point?
Yeah. And that's what's been interesting is there's certain sectors, so you have 10 sectors in the S&P 500, and really some of them done really well the first half, some of them not so much. And so put them together, and that's where you get the 1.25 that it's been. But some that we really like is IT, information technology, financials, and healthcare. IT's been super strong. It's got great earnings growth. Financials, we think those will do well because of the interest rate environment. We think it's going to increase. The higher the interest rates, the better that is for banks. They can make more money when rates are higher than if they're lower. And then finally, healthcare. It's been extremely hot. The M&A activity, mergers and acquisitions, there has been super strong, and so we think that's going to continue, and the momentum that it has, we think it'll continue through the end of the year.
What about some sectors of our economy that you don't care for, at least that you would encourage us to avoid?
Yeah, a couple of them that we're not as high on are utilities and telecom. And so utilities are a sector that did fantastic last year. It was up, I think, 24-25% in 14. But right now in the interest rate environment with them increasing, it just hasn't been as strong for utilities at this point, and we're not as high on them going forward. Telecom's similar, although telecom we're not as high on as a sector as a whole. There are certain companies within the telecom sector that we're high on. They have a good dividend yield, have some good growth potential. So as a sector as a whole, we're not crazy about telecom, but there's some companies in there that we do like.
What about to the people who just opened their power bills and they're seeing hundreds upon hundreds of dollars that are due because of our hundreds and hundreds of degree temperatures? Shouldn't we love utilities? They're making tons of money off of us.
Yeah, well, unfortunately, there's not a great correlation between the two, but
Yeah.
it is, that's a good, that kind of goes back to a different discussion. Maybe we should have budget billing if it affects us that much, but it is no fun to open your Southern Company or Georgia Power bill at this point.
Here, it's horrible. What about some positives that you see in our economy now and going forward?
Yeah, so employment's something that we see that it's getting better. That's something that we like a lot right now. The lower gas prices, although the power bills are high, the gas pump's back down a little bit, down to the low twos, so we have some more money that way too. So consumer spending's really been a positive when you combine employment and also the lower gas prices. You have more money to spend other places, and that helps the consumers as a whole because you got more money in your pocket from your job, and you also have more from not paying as much in gas. So that's a positive. Also, what the Fed's done, Janet Yellen and the Federal Reserve's done an excellent job kind of kind of staying out of the way, so to speak, and what they've done there has been a positive, we think, for the economy at this point in the year.
Any negatives on your mind right now?
Yeah, the real estate market has been one that it's been a positive. It's gone up a good bit.
Right, you've mentioned it before.
Yeah, so the real estate market's really done well. What's happened though is people, you work and you work and you work to be able to afford a house on the lower income side of things, but the price appreciation, it's almost moved too fast, and so you can finally qualify for a house, and now you can't afford the house because the price has gone from maybe 100 to 150. And so that's good if you are the homeowner, but if you're trying to get into the housing market, that's one thing that we've seen a little bit. Also, obviously international, Greece, China, Puerto Rico has been in the news some. So there's a lot of issues outside of the U.S. that are cause for concern for us.
How about from a tactical standpoint, what asset classes are you liking as we look to the end of 2015?
Yeah, so one of the things that we like is large cap and mid cap stocks. We prefer those over small caps. So small caps are a little bit more pricey. They're more expensive on a relative basis. We prefer mid caps over large cap because large cap has a lot of exposure overseas. And so companies like Coke, for example, they have a lot of exposure in Asia and Europe, South America, all around the world. They derive a lot of their revenues from there. So the stronger U.S. dollar actually hurts them, where you have maybe a mid-cap company, Under Armour. Jordan Spieth had another good week last week, didn't quite come through, but they have most of their earnings are derived from the U.S., and so they're not as affected what's going on internationally as a company like Coke may be. We favor developed markets over emerging markets on the international space. So we're not crazy, Brazil, Russia, India, China, those type of countries, we're not as crazy about that. More developed countries, Northern Europe, Japan, Australia, those type places we'd be more apt to invest at this point. What
about quickly the bond area? What do you prefer from that perspective?
Yeah, so from a bond perspective, it's very difficult because it's very difficult with the interest rate environment that we're in. We like multi-sector bond funds with kind of flexible mandates. So we don't like bonds where you have to own it for 30 years or have to own it for 15 years. We like being able to actively manage that so that you're not stuck in something for 20 or 30 years at a very low interest rate.
Will, you have covered a ton of information. This may be the most information-packed segment to date with the Fehrman Investment Group, and I appreciate it very much.
We're happy to be here and happy to help those people out there.
Absolutely, and if you didn't learn enough today, which would shock me, you need to log on to the Fehrman Investment Group's website. There it is on your screen, or just call them bright and early Monday, 706-922-3590. Their team, no matter your portfolio, is here to help. When we come back, the health of the human eye, especially your children's eye well-being, if you will. Dr. Ben Casella, optometrist, here to give us some wonderful advice when we come back.